We have officially crossed over into lunchtime. If you're on the if you're in the Eastern time zone, and what we like to do around this time is have a little trader talk, and therefore we're going to bring in Sean Udell. You know him as Tech Trader. Good morning, my friend.
Good morning. How are you?
I'm doing okay. A little better than yesterday. I'm a little under the weather, so
you know, I was fighting cold. Might still have the lingering tail of it, but yeah, about a week ago. So I know the feeling.
Yeah, well, when I'm under the weather, it's always a good thing to bring you on because I know you can just carry the show for a bit.
Hey, I'd be happy to help you any way I can.
I know. Well, one of the things I wanted to do today was do a little bit of an earnings prep. However, I saw just a few minutes ago that you made a trade in which you were exiting your position in BBBY and you bought a Pivotal. So why don't we start there and then we can work our way out?
Yeah, no, I just like it. So not Best Buy. I every time I look at Bed Bath & Beyond, it's just one B short of Best Buy.
Right.
And by the way, though, that's kind of a good Freudian slip anyway, because there is a distinct chance that over time Bed Bath & Beyond could put in a move like Best Buy put in from wherever its low was. I want to say 2013. To basically a massive 3-year move that stock put in. I think it was at least a 4-bagger Best Buy off of the I call it the Amazon will destroy any and all goodness in Best Buy and make it completely irrelevant, and therefore Best Buy is a perma short. Well, that didn't work out very well for those that were purporting that thesis. Best Buy ended up they just ended up overbuilding a little bit, and they rationalized their footprint, and Best Buy did exceedingly well, especially from their lows. And I think so. Here's the most interesting thing I can say about Best Buy. So first, I like it as a trade. I nailed the trade. I caught a nice post earnings trade, and I wanted to increase Pivotal. So that's the explanation for the short-term trade. As far as Best Buy, I'm going to keep looking, or Bed Bath & Beyond, I'm going to keep looking at it. And the reason is because it actually has a massive cash flow yield. The cash flow yield is probably in the neighborhood of 50 or 60%. So, everybody thinks, Bed Bath & Beyond is a dead retailer, a dead brick-and-mortar retailer. The company's been executing fine. They're still profitable. They still have very nice cash flow. It may have to do something very similar to what Best Buy did. Maybe have to close some stores. Maybe have to get rid of some sort of low margin inventory. May have to lean up basically and quit putting everything as seen on TV in the stores, and maybe lean up and kind of improve the quality of the inventory. Or make the inventory just less. I guess instead of having, I don't know how many items they have. Do they have 10,000 items in a Bed Bath & Beyond? Maybe reduce the item count by 35%. Sometimes that works wonders. Anyway, I still really like that long term. I really do. Long term briefing readers will remember me hitting A&F really good. Around the time I first came on the platform, and in fact, I didn't do that well. There are a lot of people on the platform that traded A&F way better than me. I caught several good trades on it. I think I had a long-term position that I did pretty well in it. But there were some people that made 2 or 3 times their money in that stock. I think my best piece of that was probably a 60 to 80% move or something like that. But yeah, no, interesting name. I'm going to keep following it, and but I just wanted to increase my pivotal position. That's PVTL. I think it's going to report well. I think it could be one of the earnings winners. It's not as expensive. It's not a cheap stock, but it's not as expensive as some of the other newer IPOs. So I just like the name. I'm going to own it for a while, and as we've discussed, I've sort of classified Pivotal as I think it could be the best of the new crop of tech IPOs of last year.
Okay, very interesting. And perhaps this might be a good example of one of the things that I asked you about prior to coming on to the show today. And that being, I wanted you to highlight some of the tech names that have reached the point of getting beaten up so much that you could throw these ones on the radar, and having the downside being so limited. For instance, we've seen plenty of times where maybe the market has priced in, or the stock has priced in all the bad news that could possibly happen, and the company may come up with a bad report, or maybe if it's a good report. But tech stocks that have had such a bad beat and are now just priced to outperform, that Q1 real catalyst in earnings. And I wanted to get a list of those names that you thought have the potential to really overachieve.
Yeah, I wouldn't say I have the list yet, but I mean, again, I would almost say that that's a lot of what I do. I mean, that as opposed to some people that, more of a price momentum traders, hey, what's breaking 52-week highs or multi-year highs or whatever, or what had a big earnings beat might be a gap and go. I kind of do the opposite of that, but I do kind of do so. A lot of what you're describing as, I think, and by the way, I think your method, I think what you described as a good thesis or a good possibly something to look at for this quarter. I think this quarter, that theory or that idea of looking for stocks that are so beaten up. I think the best way I said, they're so beaten up that even if they report a miss, the stock might go higher, or they might not go down very much and then move higher. I think this quarter is going to be a very good quarter for that to occur. I mean, we just kind of saw one this morning, by the way. I mean, I don't know. I tweeted about this earlier. I like to make fun of I guess what I call, I like to beat up the people I think who are making the absolute worst stock trades. And one of the worst things that I thought people were doing, well, really selling anything the last 3 to 4 days of the December lows was pretty heinous. I mean, literally, why would you be selling at that point? Maybe you don't want to buy because you're afraid to buy, but why would you be selling anything? After it's dropped as much as it dropped, into those December lows. But Goldman, it was a name. It's like, okay, what were the December sellers, thinking on Goldman? Well, the answer is they weren't thinking. They were either being forced to sell, or there were machines that were making money by selling, by dropping bid and selling, or there were people who were operating on pure emotion and fear and saying, get me out, I can't take the pain anymore. So the point is that there was no thought to anyone selling Goldman in the December lows, and especially, it was only 2 to 3 weeks in front of a report that frankly was probably a pretty easy call. It was probably a pretty easy call to say Goldman's going to have a pretty decent quarter. One could argue they actually just had a great quarter. But I think I even posted something around that. They're like, the odds of Goldman having a pretty decent quarter are probably in the neighborhood of like 80 to 90%. So, the bottom line, people don't think at panic buy when they're panic buying or panic selling. There's not a whole lot of thinking going on. But yeah, we just got one. As far as kind of what meets your, I don't have a whole list now. The stock, I would say, on the opposite of that, I would say Team, which is Atlassian, and Netflix. Netflix has had a massive. I was probably one of the few guys on the planet that basically said Netflix could drop 50%. It almost dropped 50%, but it's had a hellacious move higher. So these would be two how I would set these up is they're both potential shorts. I mean, the ideal short on Team would be that's TEAM. Would be a report that everybody views as super good, so good that you got to buy it. And then you get the kind of the gap and crap move. That would be an ideal. It might be hard for me not to be short a little bit of Team into that print actually tomorrow. So that's a very overvalued stock. It corrected pretty good, but that's a relatively minor correction to be honest, given the valuation. That's one of the most expensive software names in my universe, by the way. And then Netflix is kind of a similar setup. Again, Netflix, time will tell whether the sell-off all the way down to 235-ish or so was deserved or was an opportunity. Obviously, short term, it was an opportunity. I was even pinging a couple guys there. I very nearly went long Netflix, by the way. Probably 4 days off the low. I want to say my technical system pinged me a pretty compelling buy. I want to say right around 248, 250, 255, something like that. I lined up to put some call spreads. They were cheap. I just didn't fire at it because I think I was either liking what I owned or maybe looking at other things. But that setup looked good and it's fulfilled. So the question now is, though, should it have gone up? I mean, what's the move off of lows? 125 points. I would say 50, 60 points certainly was deserved. And then you're getting this tail-on reaction to a price increase. Well, price increases are good to a point. I think if you asked Apple how price increases went in 2014 and 15, they would say they're fantastic. I think if you asked Apple how those price increases of the last couple of years have gone, they might have a different answer. So I think again, everybody celebrates increase in price because theoretically it's increased margins, and it's because nobody's going to leave Netflix, right? You can't leave Netflix. They have movies like Solo on, which I'll give my review on in a minute. But they have movies like Solo on and the other Star Wars movies, that big Disney productions. There's no way I cut the cord from Netflix. I can cut the cord from cable. I don't know. Raise price one. You don't know that the price is too high until you've raised the price one too many times. It's just like Fed rate hikes, by the way. The Fed doesn't really know that they've hiked too many times until they've done the one hike that was one too many times. And then things get really weird. And the Fed has hiked. That was good. We just lived through that too. Anyway, long story short, I'm going to be looking at both Team and Netflix off, Thursday and Friday. They report Thursday evening. So we'll see. I'd like to see some really. I hope the companies deliver great reports, and I hope people are enthused about the reports. And then, I kind of hope there really isn't much lasting enthusiasm. So that's a really juicy setup. By the way, it's exactly the opposite what you just described. So the only thing I have on the radar besides Goldman, if we'd have had this show yesterday, I would have said Goldman is your perfect setup. You have to go all the way out to next week because again, we're still about 1 week away from the really juicy tech earnings reports. But Western Digital reports next Thursday. I would say that in fact, I just saw a really bad downgrade. In my opinion, it's a really bad downgrade because if you're waiting until 36 or 40 to downgrade a stock that was 110, then it was 100, then it was 80, and so on and so forth. It's a worthless downgrade. It's a zero value add downgrade. If anything, you should probably be upgrading Western Digital. I think this is going to be one of my stocks of the year. I don't really produce a stock of the year list for you guys, but I sort of do internally. This is one of my favorite names. I really like the stock, and again, I think they're exactly what you're looking for in your sort of your thesis that. Hey, who could produce a report that goes one of two ways? Either it's a bad report, but all the juice is squeezed out of it, and it's sort of like we saw with Micron on their last report. A really horrible report, but stock has not gone lower on that report. In fact, stock's traded relatively okay. It's been sort of flat. Micron's been sort of flat. It's been sort of flat to up since they had that horrific report and guide. I think Western Dig could be the same. Here's the funny thing, though. We're not that far away from when Western Dig and Micron will probably start producing better reports. I don't think I know it's not this quarter. It could be a quarter from now where some of the results start looking a little bit better. My best guess is probably 2 quarters away. But people will start sniffing out. If you basically, I call it the last bad quarter thesis. If basically you kind of know, or you get a good sense that this is the last bad quarter, usually you can get the first good move on a stock. But no, I like Western Digital a lot. That fits your thesis really well. And it's the only one on the radar. We'll have to go see. I mean, Facebook could be one. We'll have the beaten IPOs. Again, I think Pivotal's one for sure, but Pivotal doesn't report for quite a while. So I don't know. I mean, I'd say about half my focus list could end up being kind of fitting your thesis. So we'll have to see. But Western Digital is a very clear case. And I think that, I hope they have a horrifically bad report. I'd love to see the stock kind of go and retest the lows one more time. That would be my ideal setup too, because I really do want to build a pretty decent position in Western Digital. So, I don't know though. I kind of think whatever that December 24 low is, I think that was their low. I wouldn't be surprised if that low is a sticky low for multiple years. Just like, by the way, the 2016 low on Western Digital was $36. And Western Digital actually went to a lower low just recently. And if you just sort of think about that, it's crazy. Because Western Digital is a far more valuable company today than they were in 2016. But, that's what happens when stocks get weird and markets get weird and they get dislocated. And I do think the end of last year's sell-off was a stock market dislocation. And I think we saw prices that will probably be durable to the downside for some decently long period of time.
All right, and for those wondering, looks like WDC reports January 24th.
Yeah, it should be next Thursday.
Yeah, I believe so. All right, so we've got WDC as one of those stocks that I had highlighted. Now, another thing that I wanted you to take a look at is the type of stock that analysts are just behind the curve. For instance, the analyst who is, for lack of a better term, somewhat lazy with moving the numbers, is the type that there's this wait-and-see approach where they don't move numbers until the earnings come out, and then at that point the stock's already moved and it's too late. Have you found any of those type of stocks that the analysts are just waiting on and the numbers are just off, in your opinion? Any of those?
I have to kind of look. There's always some that come up. I mean, a lot of times sometimes those occur as much, not from stocks that are really beaten up and cheap, but they occur on stocks that have actually run too much. I mean, so like AAOI, which I shorted last year, was a great example of that. NVIDIA was a great example of that. Arguably, all the FANGs were a really good example. I mean, nobody started lower numbers on Facebook, even though, what did Facebook tell everybody in the world for roughly 2 to 3 quarters? That numbers aren't going to be as good going forward. And yet analysts actually held numbers or increased numbers, and then it was like, oh my God, Facebook, what are you doing to us? When you're missing numbers or guiding numbers lower. I think they've guided lower 2 quarters in a row now, and then they might have even missed numbers 2 quarters in a row. Apple did the same thing, by the way. So, I don't know. I mean, one name that kind of rings, and I'm not sure you're looking for shorts. You might have been looking for longs, but
both, either one.
Yeah, Twilio. I mean, you remember? Hey, I was one of the few people on the planet that loved that stock at 26, right? And it worked out very well. I didn't ride it to its maximum, zenith, but it was a pretty good stock for me. I made plenty of money on it, and hopefully some other people did. And $100. In fact, there was a rumor of somebody. I think there was a takeout rumor on Twilio today.
Yeah, there was. Oracle 140.
Okay, well there you go. And the stock's down. Okay, and you know what I'll say? I mean, let me look at Twilio on my sheet here. But I'll tell you this. I mean, if Twilio were to get bought, I'll say this might seem controversial, but if they get bought, I would say that the odds of them getting bought for a lower price than they're trading right now, as opposed to a premium, are roughly equal. Because to me, they're actually trading at a higher multiple than you would want to pay. I mean, typically, expensive software typically sells for 11 times out-year sales. They're way above that right now. So I think there's something in the neighborhood of 12 to 14 times out-year sales. So I don't know. I think it'd be pretty dumb to pay What are you going to do? Are you going to pay 15 times, 16 times, 18 times out your sales for Twilio? So here's my view. My view is that they're coming very close to a point where I think the earnings are going to, or the growth rate is going to start decelerating. I'm not saying they're going to start having negative revenue growth. I'm saying that the rate of their revenue growth is going to decline, the second derivative. So, and I would call this basically peak earnings, peak EPS theory. So I think Twilio is pretty close to a point that we may have seen the maximum revenue acceleration that they can produce. Very, very similar to calls I've made. And again, I said the same thing about NVIDIA, AOI, Facebook. I think I've said the same thing on Amazon, actually. And so anyway, the bottom line is Twilio is one that kind of comes to mind right away. On the downside, we'll have to see. I mean, I still think that there's one reason I remain long Twitter is because the analysts, I kind of described this about a year or so ago. I said Twitter will kind of drag the analysts kicking and screaming into upgrading the stock. Kind of one by one, they all fall down. And, we just saw it again recently. Another analyst upgraded Twitter, put a relatively muted, I don't know, like a $36 or $39 price target on it, which again is pretty muted for a buy rating. There's still, I think there's still 31 guys and gals who have a hold or sell rating on Twitter. But there used to be a lot more. I mean, when I liked Twitter and nobody else really did, and the stock was 14, 16, or 18, and I mean, by the way, my price target in Twitter then is about the same as it is now. I think I maybe moved it $6-7. It was 44 then. It's 51 now. So when the stock was 16, I said it was worth 44. It actually went to 46. My price target now is 51. Again, how many buys? There's not a lot of buys or strong buys on Twitter. That's probably, again, there's a lot more today than there were. I mean, we probably, at the point when it was 16, there might have been like 2 or 3 guys. I don't know if it ever got to a point where only one analyst had a buy rating. I think there was always at least 2 that did. I know Goldman's been very good on Twitter, by the way. Heath Terry, I think is the guy's name. He's been one of the few contrarian bulls on Twitter. But yeah, I'm showing here, there's still 30 people who have a hold or a sell on Twitter. And I would say that they're pretty offsides. They're pretty late. I mean, how much evidence do you need? I think Twitter's had in the neighborhood of 4 to 6 good quarters in a row now. And that's getting pretty long in the tooth for you not to recognize, that the stock has kind of turned around. I mean, there's still articles going, hey, what's going to cause the Twitter turnaround? It's like, oh, well, where have you guys been the last year and a half? But yeah, this will be a great. I mean, you and I will probably talk. We could talk about this theme all quarter because every time, whatever we do our talks, I mean, we can almost just have it be a feature. The first 15 minutes of the radio deal can be, hey, what are 2 or 3 or 4 setups of this thesis, either long or short? Right now, there's just not as many because there's not as many reports. But once we get past next week, tech heats up pretty good. In fact, I think then we head into the Apple, Google, Amazon, and a bunch of other reports, and then we should have plenty of reports for 4 weeks or more.
All right, and I think you're right to some extent. We probably could talk about the same type of setup, but I thought that since we have about a week before things like really ramp up, and we probably won't talk again until next week, and so if you have some others, we'll probably talk about them as well, but to give the listeners that extra preparation time so that they can do their own due diligence and come up with some names. And in fact, I'll throw this invitation out to our listeners. Toss out some ideas for TECHT, and we've got a week to digest them. If there's a stock that's been on your radar, feel free to reach out on the feedback, and we'll break them down. He's more than happy to let you know if this is the type of stock that would fit that criteria. And specifically, I'm just looking for the beaten up names that have the highest probability to really perform well post earnings to give you that really juicy earnings type play. That,
by the way, as I'm going through charts, I want to get this out so I don't forget it. I would say Spotify is a really, really juicy one. This is a name I've talked about. I believe I added this to my focus list. Let me make sure it's in my focus list. Yeah, it's in. It's in the last my most recent focus list. I put Spotify in there, and in fact, I replaced CyberArk with Spotify. I didn't like Spotify at highs, but boy, I sure liked. Once it pretty much went to 125ish, give or take 3-4 points. Once it went to about 125 or lower, I really, really liked the name. And this is one. I mean, it's like, again, there was no fundamental reason Spotify was selling off, but they could have very good results. I mean, because nothing has really changed. Whether it's a government shutdown or whether it's fears of economic growth or fears of, Italian banks or whatever. That doesn't really change the economics and in the total addressable market for Spotify. And so that's a pretty good setup. I mean, again, I'm already long the name. Because, I bought a lot of these names from anywhere from the second, third week of November to the end of December. Because if you remember, my thesis at the time was I was preparing for what I thought could be the mother of all January effect trades, and by God, we've had one. I mean, this has been the mother of all January. I haven't seen a January effect trade like this since 2013. So, but yeah, it's kind of the same general thesis. I mean, it's basically, hey, what stocks were just massively oversold, sold, and puked up for no good reason other than they were being rated or people were forced to sell them. And, therefore, I mean, something like a Spotify, it's not like they have to really have a beat and raise. They just probably can meet numbers. I mean, in fact, what you're kind of describing is a lot of stocks are probably so beaten up that they don't really have to raise, I don't think. It depends where we get, by the way. The markets are very, have a very short memory. I'm actually surprised how much the NASDAQ's gone up, by the way. So, and again, we're kind of maintaining this high sentiment reading, pretty short-term overbought situation. It doesn't really seem to be generating any selling enthusiasm yet. So, in other words, what you and I are talking about right now in 2 weeks could change radically. I mean, if we have if 6 out of the next 8 trading days are up, and the NASDAQ's another 400 or 500 points higher, it might almost be too late for exactly what you're talking about. Because if the market goes up enough, that kind of this trade that we're describing basically gets priced into stuff. So we'll have to see. Again, the Spotify has only moved back from 132 from lows. This was a stock in August of last year, which was $200. So there's still plenty of stocks with plenty of room. But I'm just saying, hey, you start putting on another 300, 500, 600 NASDAQ points, Spotify is probably not going to be at 132. It's probably going to be, 10, 15, 20, 30 points higher, you tell me. So a lot depends. This is a fluid type deal. We have to see where the market is. We have to see how things react to other earnings reports. Again, I really kind of do hope that that Netflix and team report well and don't get bid up. I think that would actually make for a better continued earnings setup. If Netflix gets really bid up on a good report and team gets bid up on a good report, we might only have another 2 weeks to make really good money in longs before we have to start thinking about more aggressively on the short side. So we'll just have to see. Not trying to throw too much cold water on things, but it is pretty surprising how much we've risen off of lows, especially in the indices in particular.
All right, so I assume that your sentiment readings that you're looking at as far as the NASDAQ are hitting pretty close to the overheated area?
Yeah, they've cooled off a smidge. I always talk about NIMO, NAMO, various other things. They've cooled off a bit, but it's still a very hot NIMO reading. I think the counterpoint is, again, kind of what I just talked about. So you can get a very hot NIMO, but if, a stock that was 210 that went to 110 has now only gone up 20 points, which is a nice move. I'm talking about Spotify. Again, you could pencil in a bunch of other names here. that doesn't that doesn't heal up the damage that was done, especially if the damage was arguably, I guess, erroneous, false, short-lived, whatever kind of term you want to put on it. But if the damage was basically pretty much just trading damage based on nothing other than, again, algorithmic raids on tax loss selling, on people being forced liquidating, that sets up a much different kind of upside move than if the downside is actually driven by real fundamental concerns. So and I think that's exactly what we had. We had there were some fundamental concerns, but the fundamental concerns didn't drive the selling. What drove the selling was we basically got what I described. It was a massive sort of exaggeration of tax loss selling window, mutual fund redemptions, hedge fund redemptions, everybody wanting out the door, jumping out the door on the same side, and that all combined with the whole, what I said would lead every sell-off last year, which is FANG. You had everybody on the same side of the boat of the FANG trade. Once that boat starts tipping over, everybody has to jump out at the same time. And that makes for, very, very violent price moves to the downside, and FANG kind of let everything down. So we'll have to see. I mean, we'll just have to see. But, sentiment is very elevated. So we have to see how long, I guess sentiment can remain this elevated without it producing any net selling. I mean, so far we haven't really seen much net selling. But it's kind of calming down. We had kind of 4 rip-roaring upside days. So far this week, the buying's been relatively muted. So we'll just have to see that play out. The other area, just to address your point, this kind of came to mind too. We saw Citigroup make a pretty good move off the report. Goldman did too. Is that maybe a broader sign of that companies that were dropped due to a lot of Fed fears could be set up? So I would just say, hey, maybe think about companies that were leveraged to the downside because there were fears of the Fed they were just going to keep ramping rates higher. And certain companies, especially, home builders, a Redfin, which I'm long, a Zillow, which I'm not long, but Zillow got killed. Things like that. I mean, if the Fed's one and done, and that's my call. I think the Fed's basically one and done. I think there's one rate hike. Now the caveat would be if sort of my 1999 Echo thesis comes in and fulfills, then obviously conditions are going to be hotter. Maybe the Fed reasserts itself and starts hiking in the back half of the year after a huge move and after a lot of economic strength that sort of surprises people. But right now, a very compelling trade setup might be things that got hammered as the Fed was raising rates. And if the Fed only has one hike next year, interest rate sensitive areas, and they got hammered. I mean, those kind of names sold off for 6 months. And that was a combination of fundamental and technical selling. And so, I have to look at the chart of TWLO, and Lennar's a name that's bounced a little. But man, these home builders just got wrecked. Redfin got beat up really bad. Zillow got killed. Again, I normally don't like Zillow. We've talked about this, but when Zillow basically crashes, and when the stock drops 35 to 50%, that's called an individual stock crash. Zillow was cut in half. And my experience is that Zillow's never been a bad buy after they've been cut in half. It's usually worked out really well. The only time it's one of those stocks I've never not made money on when I bought it, because I usually never buy Zillow unless there's like a really bad period in the stock market. Those are the only times I've ever bought it. So I've always bought Zillow on these 40-50% off sales on the stock. I missed the lows. I'm really kicking myself. I literally was looking at the stock, whatever day, it probably was the 24th. There was a day it was hitting 26s. And I was very close. I was looking at it that day, probably off and on for about an hour, and I just didn't do anything on it. But it's not like it's gone up a lot. And again, I'm not going to say that I don't think Zillow will ever be in my focus list, for example. But that doesn't mean it's not a bad buy, and it doesn't mean it can't go up. And there's all sorts of cool things on that chart. There's a gap fill. And in fact, really from about here, there's a 33 to 40 something gap fill. There's a big gap fill way, way above. I don't know if I'd even be in the stock. I don't think if I bought Zillow here, I doubt I would hold it into the 50s. Because if I got 15 points out of it, I'm sure I'd exit the trade. But maybe other people would. And there's a gap fill that doesn't even start, I think, until 52, 53. A very interesting chart. I really like that chart. So I'm going to throw that out. Maybe names that got extremely punished due to interest rate fears might be set up, because I don't think their earnings prospects have changed. Interest rates didn't go up that much. Again, what have we seen? The home builders, almost every home builder has sort of reported worse than feared. Well, we've only seen two. I think we've seen Lennar and KBH. And they both reacted pretty well to, again, the reports weren't great, but they weren't diabolically bad. So, that's an area. I think that's an area to watch out for, too.
All right. Are there any FANG names that you find attractive? Maybe Facebook?
Yeah, I do kind of like Facebook. The thing is, it's like, okay, so let's just round this off. So let's say it didn't have Pivotal, Acacia, IIVI, Twitter, et cetera, right? But Twitter's sort of a peer of Facebook, and I've said this before, I'll say it again. I think Twitter's gaining share from Facebook now. So I've kind of got some exposure. I guess what I would say is in and around the things that would drive Facebook will probably drive the longs that I have. But as we talked even in late November, you kind of missed the bulk of the excitement because you were on vacation in December. But you saw all the November excitement. The November lows were just as dynamic, by the way, as the December low. And many stocks, actually, about half of my list actually never went below the November lows, which is interesting. So a lot of those stocks, I actually like those chart setups a ton. But if you look at Facebook, I think I said around mid to the end of November, whenever that November low was, I said there's no way I'd short Facebook here. I want to say that was around 130. And I said I think even from a tactical trade, I thought Facebook was a long. And it had a nice move just from the November low to whatever the pre-December low high was. And then they didn't go much below that November low either. I'm looking at that chart right now. Okay, you could say, well, you can draw a pencil. Yeah, did it officially go below it? It did. But, it was only below that November low for maybe a couple hours, that one day. So I would actually call this a double bottom. I think that's a durable double bottom. I think it's an easy long. I think I have better longs. I think I have longs that will do better than Facebook. Here's the single biggest reason I'm not long Facebook. Is that former leaders tend to not be as dynamic to the upside the next time around. Now, could Facebook reassert itself and be a leader 2 years from now or 3 years from now? Sure, they could. But I'm talking from one side. When you go from one cycle, I'm talking to the immediate next cycle. So, like, what were the worst performers, in tech post the 1999 highs? They were none of the leaders. There were plenty of bounces. So if you want to trade these things for bounces, there were plenty of 2000 and 2002 and 2003 bounces. But what happened in tech, you got a completely new group of leaders that came out of tech. In fact, Google came out of the post 1999 sort of apocalypse. In fact, Yahoo was an emergent leader. At some point later on. But basically, you got a whole new group of tech leaders, and almost none of them were the old leaders. Look at the ultimate examples really are Cisco and Microsoft. Microsoft took 18 years, and then there were tons of points in time when Microsoft could have been a cyclical leader again. So, I'm talking, let's say the fourth tech bounce. Post 2002, so I don't know, let's say the bounce into the 2008 highs or the bounce into 2013 highs. Microsoft was never a great stock to own until just very recently. So I think the single biggest problem FANG's going to have in the next immediate cycle is that they're all former leaders. So whether it's an NVIDIA, whether it's the cloud leaders, whether it's Amazon, Facebook, Netflix, etc., again, they're going to bounce good because all the recency bias is going to have people gravitate and keep trying these names for bounces. But I would be surprised if really any of the FANGs were market leaders. So I would say they're probably going to get you sort of inline type performance to the market. They might even underperform the market for a relatively long period of time. We'll see. I would say Facebook though is my second favorite FANG. Google's my first, and Facebook would be my second. And I mean I can value Facebook pretty comfortably at about $170. So yeah, it's a good buy. I just don't know if it really gets me anything. I mean, like I'll just throw out a name like a Cloudera, which has been very maligned. They've got their merger with Hortonworks done. They sort of benefit from all sort of everything in big data, everything in AI, everything in data storage. So you could say, hey, some of the underlying drivers of Facebook's growth over time, I would say benefit Cloudera. I'm trying to think of another. Yeah, again, I still favor Twitter. Facebook, I do like it, but former leader usually underperform, might be a little stale, and then I have to see the report. I'm not. I don't know. We could talk about my Apple thesis too. I mean, Apple's many quarters away, I think, from being viable long term. Facebook could have a rough. This is just a pure guess until I see the quarter, but I'm going to say they don't probably have a quarter that really gets bulls excited again. I'm going to say about 2 to 3 quarters from now. They got to work through some stuff. They've got arguably some security issues, some expense issues, and they are much more of a target of the entities that want to attack the biggest U.S. technology companies. Twitter can fly under that scrutiny a lot more easily than I think Facebook can. So but I would say around late this year, I might start getting more interested in Facebook again. It's probably a good call spread play. That's probably the thing I would say is that, hey, if you can get some cheapy call spreads, like shoot for something like a 150 by 170. Man, if you could max out that spread, that probably has a really good payoff. I haven't looked at it yet, but I would imagine it sets up pretty well. But yeah, that would be, Google's if you just want something very stable and you want to own, arguably, the best tech mutual fund you can buy is probably Google now. Because Google's not just Google, it's all the companies they've bought along the way. They've been very good at M&A. And they've been hit pretty hard, but I think the best thing about Google is they probably had the weakest performance of the FANG names relative from low to highs over 2-3 year period of time. That stock doubled, whereas how many fold did the Netflix go up? So a Google double probably is a Netflix 5-bagger. And Google never, even at highs, Google never got overvalued. Facebook got pretty overvalued. I used to laugh at the people who would kind of point to Facebook and the PE ratios as being cheap. Facebook was I pointed out many times, they're actually very expensive on sales multiples and things like that, especially with the decelerating growth rate. But yeah, I don't mind Facebook. If I didn't have certain longs that I have, I'd probably be more interested in Facebook. I think the best way to say it is the stock would probably have to go back to probably 170, 175, 180 to get me back kind of on the short camp on it again. So that's quite a bit of room. It's got quite a bit of room higher before I think it's a short.
All right, and I guess since you brought it up, why don't we talk about Apple and why you don't think that it is even close to being a buy even at these levels?
Yeah, again, I think it can be a scalp buy. I think it can be a swing trade. I think on big scary declines on bad news where people try to say, oh man, iPhone sales are going to get even worse than they've already gotten. You can probably take some stabs at it. Here's the biggest issue I have with Apple. One is a structural strategic issue that they just seem. either oblivious to or they just seem bullheaded to is that they are buying stock and they're not buying companies. They're not buying assets. They're not buying entities that would increase their cash flow or increase their strategic presence or increase the power of the company long term. That's exactly what Google's done. That's exactly what Facebook's done. Even IBM. I've been pretty critical of IBM, and I don't love again, that Red Hat deal. They could have bought quite a few other things for the same money that they spent on Red Hat, and I think done better. But the Red Hat deal isn't terrible. It's put it this way: IBM buying Red Hat, and I've said this before, is better than IBM buying their own stock back. So I think Apple could be doing a lot of M&A, which would be far, far better than Apple buying its own stock back. Now, buying stock back at 145 or 150 or below is okay. Buying stock back at 185 to 210 and above is ludicrous. And that's what they did. They bought a lot of stock back at high. And just think about what they could have bought. Could they have bought another $5 billion in revenue? Okay, people say, well, that doesn't move the needle. Well, buying stock back doesn't add any revenue. So I'd rather add $5 billion in revenue than add zero. Buying stock back does goose EPS a little bit, but again, I'd rather goose EPS from revenue growth, not from share count reduction. But they could have arguably done $60-70 billion in M&A, and let's even say they paid rich multiple for it. Again, they could have bought roughly $7-10 billion in revenue. And that could have been very high margin, high growth revenue, by the way. It could have also been strategically enhancing revenue. So there's all sorts of things that Apple could have done with that money. I mean, I wouldn't mind if the net cash on the balance sheet was just a lot higher. I mean, when I was buying Apple in 2013, they literally were trading at 4 times net cash. So if Apple had an extra $150 billion in net cash instead of the debt, they'd have something like they'd have 280 billion, let's just call it 300 billion in net cash. So then you start doing some Apple multiples, then I'd say, hey, look, Apple's way too cheap here, guys, because it's got a $730 billion market cap and they got $300 billion in net cash. Guess what? That's only 2.5 times net cash. You got to buy this thing. Well, that's not the case. They've only got about 130 billion in net cash because they bought a whole bunch of stock and they've issued debt. So it's as simple as this for the cycle. So you got to play Apple as a cyclical play on its own product cycles. And the best cycle they have is the iPhone. It still drives a huge part of their revenue. And they're probably going to have a really great, unbelievably good iPhone cycle in 2020. And you're going to say, well, wait, that's 2020. Yeah, that's right. They're probably going to have a really, really good iPhone cycle in 2020, which means you probably got to start buying the stock into an even more dire sentiment for the company. Imagine if Apple just trades poorly for another 3 or 4 quarters. Imagine the fervor you're going to have about Apple. And that's exactly what I want to buy into. And there was like massive Apple hatred, Tim Cook. Do you remember the Tim Cook hatred, by the way, Jim, in 2013?
Not particularly.
I do. So anyway, you get you get the mobs after Tim Cook again, and you get the stock basically being maligned for another 3 or 4 quarters. I think it would set up extremely well. And again, they're going to have a hell of an iPhone cycle in 2020 because they're probably going to have 5G-enabled phones in 2020. They're probably going to miss the whole 5G cycle in 2019 to 2020. So there you go. Now, hey, they can fix this. They can decide to butter up, solve their issue with Qualcomm, solve their issue with some other stuff, get some 5G R&D going, and just make sure that the next phones they're going to make, at least they're going to have a few models that are 5G capable. But they've I think they've pretty much said they're not that worried about it. So I think that's going to create, it's going to be hard. I think it's going to be a hard slog for Apple bulls until, roughly spring, summer of 2020. That's my best guess right now. And, that's not going to be very fun. I mean, to own arguably one of the best companies in the world, if not the best company in the world, and have it just do nothing for you for another 4 quarters, it probably isn't very fun. But that's probably about where you are. Now, you could write calls on it. If I did own Apple here, I'd probably be writing calls like 5-10 points above where it's trading, and just try to and basically try to juice that Apple dividend as much as I could, for the next few quarters. But again, I can find plenty of stuff to buy that's better than Apple. And again, Apple will be, I think, going to be around the time, my guess, if I'm right on this, nobody will say to buy Apple either. So you'll have a perfect sentiment set up. Again, you'll have 5G enabled phones. Maybe by then they get some religion on M&A. We'll see. But I just don't really see much of a bull case for Apple for about another 4 quarters.
Well, for what it's worth, I was talking to one of the guys here today, and there was, I believe, an article in Barron's maybe that Apple was considering a takeout of Nintendo. I don't know how that fits.
I'd have to look at. Give me the Nintendo stock symbol. I should know. I used to know it. Okay, I just found it. NTDOY.
Yep.
Man, Nintendo they have a much bigger market cap than I. Okay, so let's play the. Okay, so what does Nintendo give Apple?
I don't know. That's what I thought you might. It seemed a little odd to me. I thought that this was, I guess, the gaming, a venture that they don't have. So.
Well, see, here's what I would do. So you know what? I mean, here again, I wrote all this years ago, and for other people, or for myself and for other platforms. I said Apple should have bought Adobe. So and that was around. I think I maintained that view for about 2 years, from like 2013.
Wait. Doesn't Apple hate Adobe?
I don't know, but I said they should have bought them.
I thought
look what Adobe's done.
Wasn't that a big thing back in the day?
No, they hated. Steve Jobs didn't like. You're making me delve into the arcane versions of my brain when I used to know almost every nitty gritty thing about Apple, because it paid me to know it, because it was one of my largest positions back then. He didn't like Flash. He liked this HTML5 or whatever. The way to render things on devices. He didn't like devices having Flash, and Flash is kind of a pain. It's a security vulnerability. It's quirky. I think it just breaks a lot. The program has to reload itself a lot. I think that's what he didn't like. I don't think he had a thing about Adobe. But let's just talk about Adobe. Hey, guess what? If Apple would have bought Adobe for $35, now. Would Adobe internally inside of Apple be sporting $250 or $240 price right now? Probably not, but it would be just as the value accretion would still be there, because Adobe probably would have done just as well from the production standpoint, the revenue standpoint. The fundamental cash flow of Adobe would have been very similar, I think, had Apple. In fact, Apple actually could have increased the Adobe software footprint quite a bit. It would have been a very good deal. So that was a company I thought they should have bought years ago. And again, just think, okay, so 34 to 240. Let's cut Adobe's in half. Let's say, okay, it should only be 150. Well, that's still a 5-bagger in value. Apple could have had all that Adobe revenue since 2013. So, I also thought years ago, I thought they should have bought EA. Electronic Arts was a really, really beaten up stock a few years ago.
Okay, so that falls in line with Nintendo.
Yeah, but I think Nintendo. I'd have to look at what. I just don't know that company as well. I don't know the revenue mix of device sales versus software for Nintendo. With EA, it's basically all software. There's no device sales. So, I don't think the gaming industry needs enough. Well, I guess if they bought Nintendo, it wouldn't be another machine. But I mean, I wouldn't hate the deal. But I think, again, what is Apple actually really good at and really innovative at is software. They don't get. I mean, everybody. The one thing I disagree with the Apple, like, I'm not an Apple bear. I've just been an Apple bear since 180 basically. By the way, that was my price target on Apple like 4 years ago. It's still my price target on 180. So I wrote a piece for you guys. One of my first pieces I came on, I said, hey, Apple at $92.95. I'm long. I love the stock. I think it's worth $180. And, I don't know, that was 2.5, 3 years ago now or something like that. But yeah, EA. I mean, how what's EA's multiple? How much has EA gone up? How much has that cash flow and revenue increased? That stock's been a stud. It's only still a $26 billion market cap, by the way. So I think when I was thinking that Apple should buy EA, I think it was a $5 billion company. So I think that's about right, because I think I had it penciled in that they could have paid a big premium and bought EA for like $7 or $8 billion. So that would have been an unbelievably good deal. By the way, EA has $4.5 billion on its balance sheet now. So they could have bought EA for $8 billion 4 years ago or something like that. I might be off on that number a little bit, but I think that's about right. And by the way, they're such a cash flow rich company that they have $4.5 billion in cash on their balance sheet. I think they do about $1 billion in cash a year or something, net cash. So EA is that would have been a great buy. Here's what would be a terrible buy. Any of the buys that most of the guys say that come on CNBC say, Tesla, horrid buy. Netflix, horrid buy. Nintendo might be okay. I like EA better. It's a lower market cap than Nintendo. I would guess that the portfolio of games on EA is quite a bit better than Nintendo. And it's got a super cash-rich balance sheet and a lower market cap. But the bottom line is I'd probably rather see them buy Nintendo than buy stock back. But there's all sorts of stuff. I said they should have bought Twitter years ago. So anyway, bottom line is we'll see if Apple gets religion. I kind of given up on it, honestly. It's part of the reason I decided to not be involved in the stock once I sold the last of my Apple a while ago. I don't like owning a company that I just don't think is fundamentally doing the wrong thing. And I think if you just look Google, Facebook, Amazon, Berkshire Hathaway. I've written for years that Apple could be the next Berkshire Hathaway, and they should have been the next Berkshire Hathaway. And instead, they basically ceded that position to Google. Google really is Google's probably the best Berkshire Hathaway now. I would say they're probably better at being Berkshire Hathaway than Berkshire Hathaway is at this point. So, we'll see what happens. I think Apple will be a very great stock to own again. Still a great company. I'm not an Apple bear. But I think they got a 5G problem, and I think they have a lack of M&A problem. I do not agree with anybody that they have an innovation problem. I think they're extremely innovative. And most of the innovation of Apple actually is you have to dig into the software and look below the surface. I mean, again, I find it funny, and hey, this is not an insult to anybody who my next phone might be a Samsung phone, by the way. I'm starting to look at them because I do want a 5G enabled phone, and I'm going to get a 5G enabled phone. I'm not going to wait till 2020 to do it. But I find it funny that when people say Samsung is more innovative than Apple. Because if you just kind of look at the models of what's happened in the industry since the iPhone came along, yeah, it's pretty clear who's copied who, and so pretty much everybody in the industry has copied Apple, right? And very, very key innovations around again how software works with hand touch, payments, eye sensitivity, face recognition, voice recognition, all the evolution really though around touch and stuff like that, and shrinking the form factor and improving performance of a device that hasn't gotten a whole lot bigger. That's really hard innovation. It's really if you know things about how to package technology at the root, it's really hard to do it well, and Apple arguably does it better than anybody. So, the whole smartphone industry is basically reverse engineered around the iPhone. So I find it pretty laughable that when people say the non-iPhone makers are more innovative than Apple. As I always said, the greatest innovation that the Android folks did was they basically made large screen phones first. But making a phone bigger is not really very innovative in my view. But yeah, we'll see what happens. And this is another reason I like the Apple suppliers, because the Apple suppliers don't just supply Apple. They supply Samsung and Huawei and all the China phone companies, or a lot of them, and a lot of the other competing devices. So I actually think we're set up for a pretty big Android cycle again. I would say you're going to have a year and a half, maybe even a 2-year period where Android sales are really strong. That's my current call on smartphone devices.
All right, ready to hit some listener questions?
Fire away.
All right, so there's one, and I'm going to pass this one on to you by email, because it's pretty extensive. It's regarding PVTL, so I want to just apologize. I will make sure he addresses this question. He had some concerns and kind of wants your take on some specific things. So as opposed to reading it all out loud, and because it's pretty intricate, so I'll just let you comment on that individually, and if you feel it's relevant to post, then feel free to go ahead. So I'll that's my apology for PVTL. I'll make sure he gets to that one for that particular listener. All right, one of the names we already talked about, CLDR. Does this one fall into that criteria, being at its basically the bottom end of its trading range?
I think so, and I've said so, and I've said so for a while. I mean, I think this is a lot like COM, which is one of my longs. I think it's a lot like, it's almost identical, in fact, to what's kind of happening with IIVI and Finisar. And it might end up being very identical. You know, another thing, by the way, I haven't mentioned, a stock I love as a long is Bristol Myers. So again, I don't just do tech, but like, especially for people who like larger, stable companies, and don't want to have to micromanage positions intraday every day. I mean, Bristol Myers, I think, is going to be a home run. I mean, they stole Celgene. I mean, I still am stunned that Celgene agreed to sell themselves for what they agreed to sell themselves for. Just as I've said, I am stunned that Finisar sold for the price they agreed to. And that leads me to Cloudera and Hortonworks. So Cloudera was able to get Hortonworks for a very cheap price, not because the agreed price was cheap, but because it was an all-stock deal. So it was a kind of a combination of like all hell broke loose to the downside. So first of all, Cloudera is going to drop if the Nasdaq drops. The Nasdaq dropped 24%. So there's no way Cloudera is not going to drop. Well, what else was dropping? All the hot cloud stocks are dropping. That's going to pull them down too. Well, what else was going on? There was hedge fund, mutual fund de-risking. That's going to drop them too. And then the capper and all this, I mean, for some reason, I don't think I've ever seen a trade this pervasive, but companies that buying other companies last year in particular just got hammered. I mean, like even super good deals, which will end up being really good, smart deals. Because what's the criticism of M&A? The criticism of most M&A deals are kind of crappy. Well, that is kind of true over time, but I think that's more of how people remember things. Actually, I think so. There is a statistical bias that a lot of M&A isn't great, but people remember the horrible buys that Hewlett Packard made. They remember JDS Uniphase buying some company for $51 billion. They never really talk about all the celebrated deals. But there are whole companies that rarely do terrible M&A deals. I mean, Oracle wouldn't be where it is today without M&A. Google wouldn't be where it is. I mean, you pretty much look at all the top dogs in tech. The only one that didn't get there without M&A really was Apple, by the way. And Apple might have actually Apple had some M&A help at its roots way back when. But yeah, no, I think this is an M&A deal kind of just gone wild to the downside. It's done. The only concern I would have, and I think it's priced in the stock, is that sometimes when companies merge, when you're merging sales teams and you're combining two companies into one, you might have a quarter or two of sort of softness. I'm not sure that's going to happen here, but I mean, sometimes you just kind of do. But I like I say, this is you combine the two companies in the space, which were the two best companies in the space, which hammered each other. So the whole reason that price competition was as severe as it was between Cloudera and Hortonworks is because those two companies are the two leaders, and we're hammering each other on price. Well, that's gone now. So I mean, this is probably one of the best M&A setups I've seen in a long time. And again, I would be surprised if they could report a report that really makes them go down a whole lot. And I mean, part of me kind of wants a stock to go to 8 or 9. I mean, it wouldn't bother me at all. I mean, this is just one. You never want to be so overconfident that you think you are absolutely sure that you know what's going to happen. But hey, even Warren Buffett said, it's like, look, when your conviction is the highest, that's kind of where you can make the most money if you're right. My conviction is very, very high on this name. So I've kind of got a full position now, though, so I don't really know if I'm going to add to it a whole lot more. But, I mean, I can model this thing to kind of at a minimum 20, 22 with ease, and I can model it to 30, 35. I think I've said many times that, a Cloudera at 30 still trades at a big discount to like an Adobe. So I'm not too worried about this thing over time. And my general guess is they will probably report reports next 2-3 quarters, which I'll be pretty surprised if the stock has much downside following those reports. So, you could have a little bit of sales, angst on, again, combining sales forces. But, the combined entity is already kind of guided for forward numbers, though, and things. So my guess is they might have taken that into account, and they might have guided fairly soft for the combined entity already. But yeah, I think the outlook looks really good. I'm really, really bullish on Cloudera over time, because the one thing I think everybody misses on this is that, there was an announcement that Amazon made it's sort of a confusing announcement related to MDB, but it's thought to be a threat to MDB. Well, what it isn't a thought to Cloudera, because what's happening in the data space is in data analytics, AI, all that stuff. Is that people do want cheaper and cheaper solutions, and the most cost-effective solution for big data analytics is Hadoop, and Cloudera literally owns Hadoop now. So there used to be two competitors for Hadoop. Those two companies were enemies. Now they're friendly, and so there's not much competition. So they basically have a Hadoop monopoly. I think put it this way, if people liked Red Hat, the old Red Hat when it used to grow a lot, and that was a good name for many years, that they should absolutely love Cloudera, because I think Cloudera is sort of like a Red Hat on steroids, in my view.
All right. Let's see. Do you cover the stock DQ? I don't know what that, how to say it.
I don't think I do. I'm gonna guess that it's a solar company, but I don't know for sure. Am I right? Is it a solar name?
Yeah, it might be. I believe it's a Chinese name. This was written in by Jill, who would love to hear your thoughts on DQ. I just don't know if you cover that one.
I don't. Here's what I'll say. If I'm right and it's a solar name, I do like solar. SunPower has mystified me greatly. First Solar is kind of interesting. Another company that I used to own, which went haywire to the upside and got cut in half or more, is SolarEdge, which is SEDG, SEDG. So that's back in a very nice viable range for me now. This is one. This might be one that fits your profile, Jim. I would almost say SEDG. They would have to have a horrifically bad report for the stock to go down much more than it has. From again, they cut it in half, and they have a funny way of having good reports. By the way, I mean this is a lot of stocks that I've maligned. By the way, NVIDIA, all the FANGs, a lot of the cloud names, things like all my shorts, right? New Relic, Varonis. I mean all the names I was short last year went up, and some of it was deserved, but my whole premise for shorting was like a huge part of the rise was undeserved. With SEDG, that whole move from sort of 20 to 60 was pretty much on the back of amazing earnings reports. I mean, so there really wasn't a time. Now, I hindsight being 2020, yeah, I wish I would have shorted SEDG too. But this is kind of, that whole move higher was sort of earned. And earned on the backs of just really good reports. And so they have a funny way of delivering the goods come earnings time. I wouldn't be a bit surprised if they have a pretty good report again. I'm not as close to this name. I followed it really much more closely a couple years ago when it was on sort of its meteoric rise. But, I don't know. That's one. So I'm looking at SEDG. I own SunPower. SunPower's been kind of disappointed, but SunPower might go down just to be. I almost wonder how the stock would have been would trade if they unwound that JV with First Solar, because a lot of SunPower's revenues now are sort of hidden in that JV, and those are the annuity stream parts of the business. So the solar deals they did, which they get a piece of the revenue over time, is now all baked into a JV. That's a jointly owned JV with them and for solar. And so now kind of the easiest thing to see is the more volatile parts. It's theoretically the higher growth part of SunPower, but it's also the part that doesn't deliver when they have a bad quarter. But yeah, so I'm kind of bullish on solar. I mean, I think I've been kind of bullish and wrong though for at least 2 quarters. Although some of the solar names have kind of, I think CSIQ is a name I know a little bit better than DQ. That's had a pretty good move off of lows. Another name is Jinko. That's JKS. To be honest, I'm not a huge fan of the Chinese solar. I mean, the Chinese solar industry has sort of done the same stuff that the Chinese tech industry has done, which is why we have this trade issue with China, a lot of IP theft and stuff like that. So I'd probably DQ, I believe, is a China name. So I'd probably favor U.S. solar over China solar. Would probably be the only thing I'd say, but it could be a good name. And I mean, I think China is making a big push for solar. I've seen CSIQ have a nice move higher. JKS has had a nice move higher. So these names might work. I mean, I probably like China solar names as much as any China names. I don't think I'm long a single China name though. I'm not a big fan of them. I did have a large position in Baidu at one time. That was always kind of my long-term favorite China name, and frankly, it still probably is. That's been cut in half, or I think it's been close to cut in half. So I don't know. I'm not going to say anything that negative about DQ because it's probably set up pretty good right now. But it's probably not a name I would own just because of some of the disciplines I practice.
All right, and this is my last question that I have. I apologize to anybody who didn't get their questions in on time. At some point, we got to wrap this one up, so this is going to be the last one, and I think it's a kind of compelling idea. I'd love to get your thoughts on this one. The listener asks, what about shorting cable companies, ATUS, CHTR? Both have so much debt and cord cutting increasing. What are your thoughts on this?
I'd have to look at the charts. I would say I like the theory. But so here's the funny thing though. Does cord cutting at the end of the day actually hurt the cable provider? See, I'd have to look at the name, and I have to look at, because if you're talking about a Cox cable, which is not publicly traded, so I guess Comcast is. So if you're talking about an internet provider, which also is a cable media company, and so in other words, most of these companies have monopolies in their respective areas to deliver the internet service. Uh-huh. So a funny thing happens. So let's say you turn your $200 cable bill into a $100 cable bill. So let's say you cut the cord and you still use Comcast for internet and you don't use any of the other stuff. My guess is Comcast margin to you is actually the same, if not higher, than it was when they were delivering the whole bundle. So I guess I would have to look at those companies and say, are these purely sort of content companies that have huge debt and are banking on delivering content, or are they companies that actually own their region? If they own the internet delivery for their respective region, even if they're heavily indebted, I'm not saying they'd be great shorts, because a funny thing could happen is that I've seen this, by the way. I mean, sometimes companies do better when they collect less revenue per customer, but they're collecting the revenue on the piece of the business that they want the most. And I would say if Comcast loses your cable bundle, but they retain you as a customer for their internet service, I don't think they really care. They might even be happier. And I would actually say if you're going to keep Comcast, this is my personal view, I would say getting the bundle is probably a better deal because you're getting all sorts of stuff for the money, for the value of the dollar. Because you're basically getting your internet pipe for a really good price then if you pay for the other stuff. If all of a sudden you get rid of the other stuff, now you got to pay full freight for the internet pipe. So yeah, I'd have to look at the names. I can't be as direct on that. I can be kind of what I said. In this area, I'll share a personal experience. I have CenturyLink, so I was able to cut the cord. I had Cox and got very frustrated with Cox cable for a lot of reasons. And so, but I looked into it, and I'm like, okay, so let's say if I just keep, so if I get Sling, get a Roku, get Netflix and the other stuff I have. Well, first of all, I don't even save any money. So if I would have kept Cox, the internet pipe, and tried to cut the cord, I'd only be saving like $25 or $30 a month, and I'm actually losing a ton of really good content from them. So I'm like, okay, that doesn't work. But thank God I had CenturyLink here. So with CenturyLink, I have a price for life deal, and so I was able to kind of cut the cord and cut my whole bill in half. But if I would have stayed with Cox, I would have basically paid as much for the internet service as I kind of do for everything now. And so I think it's really that simple, though. You'd have to look at the company. But the other thing, I wouldn't get too hot and bothered on debt. You have to do a lot of research on debt. A lot of companies are able to operate with a high debt load for a long period of time. So you have to kind of know, is that debt particularly bad for that company? Is that debt excessive relative to history and all that kind of stuff? But a lot of companies can operate with a very high debt load because they have super, super consistent cash flows. And the whole business is set up to operate under a heavy debt load. And not that I love, part of the reason I trade tech and a lot of the tech companies they trade don't have debt, or they have huge amount of net cash. But yeah, I'd have to look at those names. I don't know those particular names as well, but I don't know. What I'm looking at shorting is going to be the same stuff I shorted before. The FANG stocks are accelerating to the upside pretty fast. A lot of the cloud stocks are still pretty high. So I don't know. That's where I'm going to go. I tend to stick to what I know. Again, he has a good point, and it might work. But you just have to kind of know enough to know if that's going to work or not. I can't speak to that as much as on those particular names, I guess. So sorry for not being as definitive, but I'm not going to give a false answer on something that I don't understand as well.
Well, I'm sure that's appreciated. It is from my end. We don't like to make stuff up, and I'm glad you didn't either. So
no, somebody else might just pull up a chart and say, "Oh, it's a short based on a chart." That can work at times. I'd rather have both. I'd rather have everything line up. I'd rather have the chart, the sentiment, and the fundamentals line up, because then I think your odds of success are a lot higher. Here's something I think he's on to, is that over time, companies with a high debt burden could come under more pressure as interest rates go up, or if there's more kind of PCG type issues out there. So it's possible that companies that if they don't manage their debt loads well, in other words, when the Fed was at zero and staying at zero, a high debt load is easier to manage. So there is something to his theory that, hey, if a company's not smart about their debt load, and interest rates go up, that does pose more risk to those companies. So again, he's onto something. I just can't speak to that particular segment with any authority.
All right. Did you get the instant message from me just now regarding that PVTL?
Let me look. Where did you send the instant message to?
The same box that we connect on the. If you didn't get it, I'll just make sure you get email.
No, I got it.
Okay,
Yeah, I just looked.
All right, good.
Yeah.
All right. So, take a look at that, and I'm sure that'll help out the listener who had the question in PVTL. Let's see. Wow, this went by really quick. We're already an hour and 20 in.
Do we have 3 minutes to talk about solo? Or if we don't, hey, we can do it offline. But I have a bone to pick with you.
All right. Well,
we can do it offline.
We're gonna do that.
If you don't want to.
No, I'm not gonna bore anyone with our conversation with the Star Wars movie.
Darn, because I think it could have been fun.
I'm sure it might have been for me and you. You're welcome, audience. So we'll just leave it at that.
We'll save them from the pain that I had to endure watching that movie. I'll close on that.
All right. Well, this is a great place to hang up on you. So. All right, my man. Well, thank you as always for the good stuff, and we'll check back in next week and see if you have any other ideas heading into earnings. Thank you so much, Sean.
All right, sounds good.
All right.
Later.
Bye.